Welcome back to Accounting 101. Today we're going to talk about Chapter 2, the recording process. In Chapter 1, as a reminder, we talked about analyzing transactions. We learned about the accounting equations, assets equal liabilities plus stockholders' equity, and we looked at transactions and put them in the proper buckets, an asset, a liability, stockholders' equity, which can be broken down into retained earnings, which is revenues minus expenses, and dividends. We'll learn more about that and see more of that same examples, but specifically in Chapter 2, we're going to learn about accounts, debits and credits, and see how they're used in business transactions. We'll talk about journals and how that is used in the recording process, and then how a ledger and posting help in the recording process. And then finally, we'll prepare a trial balance. That's the first step into getting our financial statements. Debits and credits. Debits and credits record increases and decreases of a specific asset, liability, stockholders' equity, revenue, or expense item. Okay, I don't have a good definition of what debit and credit is, but the key thing to remember is debits are on the left, credits are on the right. So we could have just used left and right, and it would have mean the same thing as far as analyzing and recording transactions. We use T accounts in accounting, and that's that illustration in the lower right there. So the left side is the debit side. We abbreviate debits as DR. The right side is the credit side. We abbreviate that as CR. So debits and credits. Okay. As we go through examples and learn how to use T accounts and help in the recording process, you may think it's pretty rudimentary or pretty simple, but it is a key tool in analyzing transactions. I've been in meetings where we've had 3 high-level accounting people from different divisions talking about new transactions and how they're going to operate. And what do? We go to the whiteboard and we do T accounts. So I use this quite a bit in my job. It's a way to break down the transactions in its basic form, and a way to organize data, and it's a good tool to have. So we'll learn more about that as we go along. So if we look at the cash account for SoftBite Company, there's 2 ways we can look at it. The left is the tabular summary. Okay, start with the balance of $15,000. We spend $7,000, so we show that as a decrease, so a minus. We receive some cash, $1,200, then $1,500. We add that. We subtract this $1,700 where we spent some cash. We spend another $250 on something, so that's a negative. We received $600, so that's a positive. And then finally, we spent $1,300, another negative. Sum up that column, we get a balance of $8,050. So we started with a $15,000, we had some transactions, and we left with a balance of $8,050. If we look at the account form, or the T account on the right side, remember we have our debits on the left, credits on the right. Cash is an asset, and we'll learn more about this in a little bit, but debits are an increase of cash, an increase in asset, credits are a decrease. So in this case, we're going to put the increases on the left side. So anytime in that tabular form you see an increase, including the beginning balance because that's positive, it goes on the left side. All the negatives are a decrease of cash, a decrease of the asset. We put that on the right side, the credit side. And if we add up the debits, add up the credits, the debits are higher than the credits, so our balance in this account is a debit balance, and we show it at the bottom with the debit and the total balance. We'll get more into how that works as we go through some other examples. So accounting is a double entry system. Each transaction must affect 2 or more accounts so that the accounting equation stays in balance. Recording is done by debiting at least one account and crediting at least one other account. Okay, and debits must equal credits. So in Chapter 1, we talked about assets must equal liabilities plus stockholders' equity. We're going to talk more about that, but we're also going to talk about debits equaling credits. Okay, those are two key things that we're going to hammer throughout this semester, that assets must equal liabilities plus stockholders' equity and debits must equal credits. Two truths that have to happen in every equation or every transaction. What causes a debit balance? We touched on it briefly, is that if the sum of the debit entries are greater than the sum of the credit entries, the account will have a debit balance. Okay, pretty simple. Debits are more than credits is a debit balance. So here's an example. If we have transaction 1, it's a debit to this account. We put that on the left side as 10,000. Transaction 2 is a credit to this account. So we put that on the right side, $3,000 there. And transaction 3 is another debit. That equals $8,000 on the left side, on the debit side. So we have $18,000 of debits, $3,000 of credits. The balance is of $15,000 debits. What causes a credit balance? If the sum of the credit entries are greater than the sum of the debit entries, the account will have a credit balance. Okay, so it's just the opposite. Credits are greater than debits, it's a credit balance. So if we have transaction 1 that's a debit, put that on the left side, it's $10,000. Transaction 2 is a credit, it's $3,000. Now in this example, transaction 3 is a credit of $8,000, so we put that on the right side, the credit side. We have $11,000 of credits, which is more than the $10,000 of debits, so we have a $1,000 balance, and it's a credit balance because the credits are greater. Asset and liability balances. So assets, debit should exceed credits. Okay, so most assets have a normal debit balance. So debit should exceed credits. Liabilities, credit should exceed debits. So it has a normal credit balance. And the normal balance that I just spoke of is the side of the account that is the increase side. So debits increase assets, credits decrease assets. Debits decrease liabilities, they increase liabilities. Okay, and here's T account examples with that same information. Assets, a debit increases, the normal balance is debit. Liabilities, credit increase that account, and the normal balance is credit. If you think back to the accounting equation, assets equal liabilities plus stockholders' equity. Assets are on the left of the equal sign. Debits are on the left. The normal balance for assets is a debit. Liabilities are on the right side of the equal sign. It's a credit is on the right side. Normal balance is a credit. Credit increases the liabilities. Okay, so that's a way you can hopefully help remember that, which is the normal balances. Okay, common stock. It's part of stockholders' equity. Similar to liabilities, that a credit increases the balance in this account. A debit decreases the common stock balance. So if you look at the T accounts, the debit on the left, the decrease, credit on the right, increase, normal balance is the credit. Retained earnings. Okay, again, debits decrease retained earnings. A credit will increase retained earnings. Since the increase is the credit, the normal balance is a credit. Okay, so far we've seen that everything that's on the right side of the equal sign has a normal credit balance. The assets on the left side of the equal sign have a normal debit balance. Dividends. Dividends and expenses, we'll talk about dividends first, but it's an account that's part of stockholders' equity, but it decreases retained earnings, which then decreases stockholders' equity. So a decrease to stockholders' equity is a debit. So a decrease to retained earnings is the debit. But for dividends, a debit will increase that account. Okay, so there's always exceptions in accounting. This is one of the exceptions. It's a stockholders' equity account or retained earnings, but it acts to reduce retained earnings. So the debits and the normal increase and decrease that you would think of a stockholders' equity account is reversed for dividends. Okay. Revenue and expenses. Okay. Revenues, an increase in revenue is a credit. So the credits increase revenue, a debit decreases revenue. The normal balance is a credit. Expenses, an increase in expense is a debit, which is a decrease of retained earnings. But in the expense account itself, it's an increase. The debit increases that balance. You should have normally have a debit balance in your expense accounts. Okay. Dividends and expenses are a little confusing. We'll get more into how they work and how they operate as we go through some examples. Let's look at the Chicago Cubs. Didn't quite work out in 2025 as well as we'd like in the playoffs, but it's a baseball team. They typically have these major revenue and expense accounts. They'll have revenues for admissions, the ticket sales. They'll have revenues for concessions, television and radio, advertising. Okay. The expenses that they have are player salaries, administrative salaries, travel, and ballpark maintenance. So that's just an example of some of the accounts that the Cubs as a sports team might have. Okay. Now, if we think about the Chicago Bears, it's a different sport, play at different times of the year, but would the team likely have the same major revenues and expense accounts as the Cubs? And the answer is yes, because they are similar business, professional sports. Many of the revenue and expense accounts for baseball and football teams might be similar. Okay, so that's just a way as you relate to businesses and some of the accounts that we're talking about and how they relate to their business. When we talk about stockholders' equity relationships, the income statement is made up of revenues minus your expenses to get a net income or net loss. So as long as revenues are more than the expenses, you have net income. If expenses are more than revenues, you'll have a net loss. That net income or net loss goes into the retained earnings statement, which takes the beginning retained earnings plus the net income, or if it's a net loss, you would subtract the net loss and then subtract the dividends, and you get ending retained earnings, and then ending retained earnings is part of stockholders' equity. Okay, so as part of stockholders' equity, revenues, retained earnings have normal credit balance, just like you think of other stockholders' equity accounts having a normal credit balance. Expenses decreases net income, which then decreases retained earnings. Dividends also decreases retained earnings. So expenses and dividends have a normal debit balance, the opposite. Here's a summary of the debit and credit rules. Okay, similar to what we looked at in Chapter 1, assets equal liabilities for stockholders' equity. We had accounts for under assets, accounts under liabilities, different accounts under stockholders' equity, and we put pluses and minuses in that graph or that chart like we did in Chapter 1. What we were really doing is debits and credits, but we just didn't call it that. Okay, so if we increased an asset, we received cash, for example, we put a plus under the asset, under the cash. What we're really doing is putting a debit. Okay, if we did that because we issued common stock, we would put a plus in the common stock column. Okay, that's actually a credit because we're increasing common stock. Okay, so using this chart and what we did in Chapter 1, you can kind of see how they relate, and it'll be a good review as you're understanding and learning this. So a question, debits. Do they increase both assets and liabilities? Do they decrease both assets and liabilities? Do they increase assets and decrease liabilities? Or do they decrease assets and increase liabilities? And the answer is C. It increases assets and decreases liabilities. So a debit will increase the assets, decrease the liabilities. Credits will do the opposite. Accounts that normally have debit balances are assets, expenses, and revenues, assets, expenses, and equity, assets, liabilities, and dividends, or assets, dividends, and expenses. So one of those groupings, all the accounts listed have normal debit balances. The answer is D, assets, dividends, and expenses. Okay. A way to remember this is to remember dead. Okay. If it's dead, it's a debit. Everything else is a credit balance. Okay. What does dead stand for? Debits are expenses, assets, and dividends. So expenses, assets, and dividends are debit accounts. Everything else is a credit account, normal balance. So debits are expenses, assets, and dividends, or dead. So here's an example. Kate Brown, president of Heritage Inc., has just rented space in a shopping mall in which she will open and operate a beauty salon. A friend has advised Kate to set up a double entry set of accounting records in which to record all of her business transactions. Identify the balance sheet accounts that Heritage Inc. will likely use to record the transactions needed to establish and open the business. Also indicate whether the normal balance of each account is a debit or credit. Okay, so think about that a little bit. What types of accounts do you think they would need? We're going to need some assets. We'll start there. Okay. Some examples might be cash, supplies, equipment. They all have a debit balance because they're all assets. So you'll probably have liability accounts. Okay. Liabilities are when you owe a creditor or owe a bank. So notes payable, credit balance. That's typically a loan to a bank or loan to some other creditors. Accounts payable, you buy in supplies or equipment on account. You're not paying cash for it up front. So that's an accounts payable. That's a credit balance. Then we'll have equity accounts, common stock with a credit balance. Eventually, as she records transactions and closes the books, she'll have retained earnings as well. And as she has transactions, she'll have revenues and expenses as well on the equity side. Now we'll talk about journals. So remember this graphic of the different steps: analyze, journalize, post, trial balance, adjusting entries. We're going to see that a lot, especially in the first 4 chapters. We talked about analyzing in chapter 1. Now we're going to talk about journalizing transactions. Okay, so you get an invoice. That's that number 1 there. You're going to analyze the transaction. We'll enter the transaction with a general journal, and we'll learn about how we do journal entries. And then we'll post those entries, the next step, into the general ledger. So we transfer from the journal to the ledger. So that's what we're going to talk about and learn today. So the journal is the book of original entry. It shows debits and credit effects on specific accounts. It contributes to the recording process by disclosing in one place the complete effects of a transaction. So when you do a journal of a transaction, that's the complete transaction, what accounts were debited and credited and for what amounts. It provides a chronological record of transactions. So you should be recording these as they happen throughout the month or throughout the period. So you'll do things that happen on the first, things that happen at the end of the month, you'll do last. And it helps to prevent or locate errors because the debit and credit amounts can easily be compared. So each journal that you do, the debits must equal credits. Okay, so if you have a problem at the end and they don't, you can look journal by journal and see if you have a journal that the debits don't equal credits. Journalizing is the entering the transaction data in the journal. Here's an example. September 1st, stockholders invested $15,000 cash in SoftBite in exchange for common stock, and SoftBite purchased computer equipment for $7,000 cash. So we'll go through the numbers down here. First thing you do, number one, is you put the date. So September 1st is when these transactions happen, so you record that on September 1st. Number two, you're going to list the debit accounts. So in this case, cash. We received cash of $15,000, so we put the account title cash. In the debit column, we'll put $15,000, so we debit cash $15,000. We're increasing cash for that $15,000. Next, we'll put the credit account, common stock in this case. So they invested $15,000 in exchange of common stock, so we're going to show an increase in common stock. Common stock has a credit balance, so we're going to credit that account to show that increase for $15,000. And then it's always good to put a description with each entry. So we issued common stock for cash. So as we go back later and we see this entry, it may not be as obvious of what it is. Cash and common stock is pretty obvious. You issued common stock for cash. But if we look at the next one, we bought equipment, purchase of equipment for cash. Yeah, you could say you bought equipment, but I would even put a little bit more descriptions in that explanation. Maybe purchase computer equipment could be a way. So when you look back, you can see that. And then the reference column, number 5, we'll see that when we go to the posting. Here's a compound entry. So we talked about debits must equal credits, and each transaction must debit at least one account and credit at least one account. You can have transactions where more than one entry is debited and more than one entry is, or more than one account is credited. Okay, so it can be either multiple of each or a single of one and multiple of others. So in this example, Butler Company purchases a delivery truck costing $14,000. It pays $8,000 cash now and agrees to pay the remaining $6,000 on account. Okay, pretty typical transaction when you buy a vehicle, a truck in this example. You put some money down, that's the down payment, and then you borrow the rest. That's what you're doing when you buy something on account. Okay, companies don't always have to get a loan for that. They can just have a line of credit with some of their suppliers, and we use that accounts payable. So put the date, July 1st. We're debit equipment. A truck is a piece of equipment, so we're going to increase the equipment account for $14,000. That's the value, the historical cost of that piece of equipment, so we put the total in there. We credit cash, $8,000. Since we paid cash out, we're decreasing cash, so we're decreasing that asset with the credit. And then we have amount that we still owe the vendor, so we put that in accounts payable. That's a liability, so we owe that and we're going to pay that in the future. Then we increase liabilities with the credit, so we credit accounts payable $6,000. And our explanation or our description, purchase truck for cash with balance on account. Okay, so we have 3 accounts that were used. Our total debits in this transaction is $14,000. We only had one account. Total credits are the $14,000, even though it's 2 separate accounts, the total still equals $14,000. Debits equal credits. If we think about our accounting equation, equipment and cash are assets, and accounts payable is a liability. So do assets equal liabilities plus stockholders' equity in this transaction? They do, because we're increasing assets $14,000. But since we paid cash, we're decreasing an asset $8,000. So our net increase in assets is $6,000. We put a credit to accounts payable, so we increased the liability. We increased that by the $6,000. So debits equal credits, and our accounting equation, assets equal liabilities plus stockholders' equity still holds. Okay, now we'll have some more examples of journal entries. So president and sole stockholder Kate Brown engaged the following activities in establishing her hair salon, Here It Is Inc. So first, she opened a bank account in the name of Here It Is Inc., deposited $20,000 of her own money into this account in exchange for shares of common stock. Then she purchased equipment on account to be paid in 30 days for a total cost of $4,800. She interviewed 3 people for the position of hairstylist. Now we're going to analyze and prepare the entries to record these transactions. So the first one, opened a bank account and deposited $20,000. We're going to debit cash $20,000, credit common stock $20,000. Okay, so as we go through some of these examples, we're not going to complete the full process because we don't have the date always and we don't always have the description, but those are things that you should do as you're doing journal entries. Most companies, when they use electronic or computer accounting systems, that forces you to do that, so you'll capture it that way. But just for simplicity, we don't do all that in some of our examples here. Second one, we purchased equipment on account to be paid in 30 days for a total cost of $4,800. Okay, so think about what increases, what, if anything, decreases, what gets debited, what gets credited. We're buying equipment, it's an asset on account, it's a liability because we're going to owe that in 30 days. We're going to debit equipment for $4,800, credit accounts payable for $4,800. And the last transaction we did is we interviewed 3 people for the position of hairstylist. Okay, what entry do we make for that? For those of you that said none, you're correct. There's no entry. So it's a business function or a business process that happened, but there's no economic impact by just interviewing someone, so there's no accounting entry. If we were to hire someone in that position and we start to pay them, we will then have entries when we record the paycheck. Next, we'll talk about posting to the ledger. Okay, we analyze transactions, we journalize them, now we're going to post them to the ledger. We have asset accounts, we have liability accounts, we have stockholders' equity accounts. Okay, so we'll learn and look at how that works as we post to the ledger. So the ledger, in this example, we have a 3-column format of an account. Okay, we have the name of the account on the top. Most accounting systems, they also have a number for the account, so cash, in this case, the number is 101. We have dates down the side of when the transactions happened. Explanations, that should be filled out, but in this example, we aren't filling out the explanations. A reference column, a debit column, a credit column, and then a running balance column. Okay, the balance is made up of, in this case, cash. It's a normal debit balance, so $25,000 debit, $25,000 balance. The next transaction, we spent cash on something, so we decreased cash $8,000. So we're going to decrease our balance from $25,000 to $17,000. We then received cash $4,200. We add that to the $17,000 to get $21,200. So that's how that running balance works in the ledger. So we'll talk about ethics. These get thrown in different chapters. Sometimes they are very pertinent to what we're talking about. Sometimes they're not, so it's a little break. I think it's chapter 7. We talk about controls, and we'll have a lot of these examples. That's always a fun chapter. So sometimes a company's investment securities suffer a permanent decline in value below their original cost. Okay, when this occurs, the company is supposed to reduce the recorded value of the securities on its balance sheet, or write them down, is the common financial lingo, and record a loss. Okay, so we're talking about a company that owns or has an investment in another company, for example, or they have possibly some loans to other companies. And if that value takes a permanent decline, you're supposed to write it down. Okay, so when we learned in chapter 1 the historical cost, we record things at historical cost. Um, we very rarely write it down, or we very rarely write it up. We don't write it down as we use an asset necessarily, but um, uh, this is a case where if there's a permanent decline, you're supposed to take that and recognize that loss. So during the financial crisis of 2008, employees at some financial institutions chose to look the other way as the value of their investments skidded. So a number of Wall Street traders that worked for investment bank Credit Suisse Group were charged with intentionally overstating the value of securities that had suffered declines of approximately $2.85 billion. So one reason they may have been reluctant to record the losses is out of fear that the company's shareholders and clients would panic if they saw how big the losses were. But they also could have personal self-interest that may be equally to blame. So a lot of the bonuses were based on the value of the investments. So if they write the investments down in value, they're going to get a lower bonus. Okay. So what incentives might employees have had to overstate the value of these investments? Fear the company's shareholders and clients would panic, and then also the self-interest of not getting the biggest bonuses they might if the investments held their value. Okay, back to accounting and posting journal entries. So we have this example where we issued stock for $15,000 cash. We learned how to journalize that. So that's that blue box up at the top. Now we're going to post that to the ledger. Ledger, we have separate tabs or cards. Think of it that way. If you had a card, a bunch of 3x5 cards in a little box, you can think of that as a ledger. As you look at the journal and you're going to post it, you pull the card out for the account that's affected, and you write the information down. Okay. Now, with the computers, it's a lot easier than that. You don't have to have all that manual transactions, but visually that might be a way that you can think about what's really happening. So on September 1st, we debited cash for $15,000. So on the ledger, we're going to put the date September 1st. We should copy the explanation down. I don't know why they haven't done that in the example, but you should do that. The reference, we're going to reference J1. So if you look up at the journal entry, the general journal, we have a journal number there, J1. So we reference that in the ledger, so you can always go back to that journal entry easily. It's a debit of $15,000, so we put $15,000 in the debit column. It's the first transaction for this account, so there's no balance to begin with, so our balance is at $15,000. Okay. Then we look and we see that cash has a number, account number of 101. We can pull that back up into the general journal into 101 to show that we posted that entry into that account. Okay. Next, we'll do the same thing for common stock. We have the date, references J1, but then we're going to take the credit amount and put it in the credit column for common stock at the bottom. That's account number 311, so we put that back up in the journal, and our balance is a credit of $15,000. So that's posting journals to the ledger. Okay. It's pretty simple, but there's room for a lot of mistakes here. If we took that cash entry and we could put the date right, the explanation, the reference, we could have the amount right, but if we accidentally put it in the credit column instead of the debit column, we're going to throw things off. So you have to be careful as you're doing it, even though it seems pretty simple. It's a way that we're going to get our balance in the accounts easier, so we have to make sure we do it correctly. Another review question, posting. It normally occurs before journalizing, transfers ledger transaction data to the journal. It's an optional step, or does it transfer journal entries to the ledger? The answer, of course, is D. We do the journal entry, then we transfer those journal entries to the ledger accounts. Now we'll talk about chart of accounts. Okay, we saw a little bit of this as we were doing that example, but companies have a chart of accounts. What that means is a list of all the accounts that are available to use. Typically has the account number and a description of the account. We can divide it into different categories. So in this case, we have assets, liabilities, stockholders' equity, revenues, and expenses. Okay. Again, if you're doing it in a computer system, you'll set this up, and those are the only accounts that you can use. You can't use other accounts unless you make a decision to add something to your chart of accounts. If you look at the numbering that we have the assets all start with 1. That's pretty typical. You put your assets first. Liabilities start with a 2, so you can see the liabilities together. Stockholders' equities are 3. Revenues are 4. Expenses, in this case, they have 6, 7s, and 9s. I've seen all kinds of things in expenses, starting with 5s because revenues are 4. So there's different ways. There's no right or wrong way to do it. There's no GAAP rules, there's no FASB rules, there's no IFRS rules that say how you need to number your accounts. What companies typically do, especially U.S. companies in using U.S. GAAP, they start with and put them in order of how they want to see them in trial balance, which we'll see at the end of this chapter. And it's a way you can just sort the accounts by the number and see groupings together. Okay, but again, it's just guidance. There's no regulations or rules that say how you have to do it. So we'll look at Haynes Celestial Group. Recording a financial transaction in company's records should be straightforward. If it determines that a transaction involves revenue, it records revenue. As an expense, it records expense. Pretty straightforward. Sometimes, however, it's difficult to do so. For more than a year, Haynes Celestial Group, which is an organic food company, did not provide income information to investors and regulators. The reason was that the company discovered revenue irregularities and said it could not release financial results until it determined when and how to record revenue for certain transactions. When they missed 4 deadlines for reporting earnings, the company suffered a 34% drop in its stock. As one analyst noted, it was hard to fathom why a seemingly simple revenue recognition issue took 1 year to resolve. In other situations, outright fraud might occur. So regulators charged Obsidian Energy for fraudulently moving millions of dollars in expenses from operating expenses to capital expenditure accounts. By understating and reporting operating expenses, they made it appear that they were managing costs and increasing in income. These examples demonstrate that getting the basic transaction right is the foundation for relevant and representationally faithful financial statements. Okay? So why is it important for companies to record financial statements completely and accurately? If companies fail to record transactions completely and accurately, financial statements will no longer be relevant and representationally faithful. So investors cannot rely on them. So often the company stock will drop because of that. If it becomes fraudulent, people can go to jail. So we need to get the transactions correct. Investment of cash by stockholders. Okay, so we're going to have a transaction where cash of $10,000 invested in Pioneer Advertising by C.R. Bird in exchange for $10,000 of common stock. So we've analyzed the transactions, and we're going to do the equation analysis. Assets and stockholders' equities are being affected. We determine what account is involved. So the asset is cash, stockholders' equity is common stock. Determine what items increased and decreased and by how much. Okay, in this case, cash increased and common stock increased. So we have 2 increases, but one increases with the debit, cash. Common stock increases with the credit, so debits equal credits. So we've translated that increases and decreases into debits. We make the journal entry, and then we post it to the ledger. Okay, so that's taking the transaction from something happened, we do the analysis, we journalize it, and we post it. So that's the first 3 steps that we've talked about. So here's an example where we purchase office equipment. So on October 1st, Pioneer purchased office equipment costing $5,000 by signing a 3-month 12% $5,000 note payable. Okay. Basic analysis is the asset equipment increases $5,000, the liability notes payable increases $5,000. In the accounting equation, we have a plus $5,000 on the asset side for equipment, plus $5,000 on the liability side for notes payable. If an asset increase, it's a debit, so we're going to debit equipment. Liabilities increase is a credit, so we're going to credit notes payable. We do the journal entry, and then we post that journal entry into the ledger. Another example, Pioneer receives $1,200 cash advance from R. Knox, a client, for advertising services that are expected to be completed by December 31st. Okay, so in this case, the asset cash increases because we received the cash from the client. Now we have a new liability. It's called unearned service revenue. We'll talk more about that in other chapters, but just know that unearned service revenue is a liability. Okay, we're going to increase that liability of $1,200. So the equation, increase cash, increase liabilities, increase of an asset is a debit, increase of a liability is a credit, debit cash, credit, unearned service revenue, and then we take that journal entry and post it to the ledger. Okay, I mentioned that there's always exceptions in accounting. Almost every liability account is going to have the word payable in it. So we've seen accounts payable, we've seen notes payable. We'll talk later about salaries payable, tax payable. If you see that word payable, you're pretty sure it's a liability. Unearned service revenue is the exception. There may be a couple others, but that's the biggest one. Doesn't have a payable in it. It has the word revenue, so you think it might be a revenue account, but it's unearned, so it's a liability. And again, we'll see that account later, especially when we talk about adjusting entries in a couple chapters. Monthly rent, same thing. We paid office rent for October in cash. Analyze the transaction. We're going to decrease our assets, decrease cash because we spent it. We're going to increase rent expense, but it actually decreases stockholders' equity. Okay, again, expenses, dividends act differently on stockholders' equity. So we're going to debit rent expense. So we debit the expense, we credit the, we debit the expense, we increase the expense. So we're going to show rent expense debit $900. Since we paid cash for it, we're going to decrease that asset cash. We do that with the credit. And then we post it to the ledger. Then we pay $600 for a 1-year insurance policy that will expire next year on September 30th. The asset cash decreases $600 because we spent it. Okay. Payments of expenses that will benefit more than one accounting period are prepaid expenses or prepayments. Okay. When a company makes a payment, it debits an asset account in order to show the service or benefit that will be received in the future. Therefore, the asset prepaid insurance is increased $600. Okay. Again, this is one of those weird accounting things. We pay for something, but we're not going to use it right away. So we put it on our books as an asset. We're going to increase that asset, prepaid insurance. So increase that asset with a debit. We spent cash, so we're going to decrease cash. We do that with a credit. Do the journal entry, debit prepaid insurance, credit cash, for $600, and we post that to the ledger. Purchase of supplies on credit. So they purchase an estimated 3-month supply of advertising materials on account from Arrow Supply for $2,500. The asset supplies increases $2,500. The liability accounts payable increases $2,500. Okay. Increase assets, increase supplies, it's a debit. Increase the liability accounts payable, that's a credit. We can do our journal entry and then post it to the ledger. Okay, supplies is another example where it's a prepayment. We're buying supplies that we're going to use in our business, but we're not going to use those assets. Supplies, I think you can wrap your head around a little easier because it's a physical thing, and you're going to use it up in the future. Insurance, rent, a couple of things that you might prepay. That's just, you're going to use it over time. So there's nothing physical that you're doing. So it's the concept's a little bit more vague, but it's very similar. Same kind of concept as you paid for something. You're not going to use it right away. You're going to use it in the future. So it becomes an asset. Hiring of employees. Pioneer hires 4 employees to begin work on October 15th. Each employee is to receive a weekly salary of $500 for a 5-day work week, payable every 2 weeks. First payment is going to be made on October 26th. So on October 9th and even October 15th when they start working, it's a business event. So the business but a economic business transaction has not occurred. Okay, it's an agreement that the employee is going to show up and work. So we don't need to do a debit credit analysis because there's no accounting entry to be made. So the first entry related to this is going to be on October 26th when we make the first paycheck. Receipt of cash for services performed. So on October 20th, Pioneer receives $10,000 in cash from Copa Company for advertising services performed in October. So the asset cash is increased because we're receiving cash. The revenue account, service revenue, is going to increase $10,000. So we performed a service. We're in the business of providing advertising services. So when we do that, we can recognize the revenue. When we generate revenue, we increase revenue and increase stockholders' equity. Increase to cash is a debit. Increase to service revenue is a credit. So we have a debit to cash, a credit to service revenue in our journal, and then we can post that to the ledger. Payment of salaries. So October 26th comes along. We're going to pay our employees $4,000. Okay, so we're paying cash out of $4,000, and we're going to recognize the salaries and wage expense because that's what we spent the money on. Okay, so if we increase salaries and wages expense, that's actually a decrease to stockholders' equity, but it's an increase to the expense account, so we're going to debit the expense account. We paid cash, we're going to reduce cash. We reduce cash, we reduce assets with a credit. So we're going to debit salaries and wage expense for $4,000, credit cash $4,000 to pay for the salaries. Okay, and then we can post that to the ledger. Declaration and payment of dividend. So on October 31st, Pioneer's Board of Directors declares and pays a $500 cash dividend to stockholders. Okay. Future chapter, we'll talk about dividends and how they work in more detail. Stuff that we're going to see in these early chapters are pretty straightforward, that they declare and pay a dividend. That's what we need to worry about, and that's how we record the transaction. So we're going to increase the dividend account, $500, decrease the asset cash by $500. A decrease to cash is a credit, so we're going to credit cash $500. Increase to dividends, Even though it's a decrease to stockholders' equity, dividends is part of DED, we're going to increase the dividends with a debit. So we debit dividends $500, credit cash $500, and then we can post that to the ledger as well. So now if we look at all of the entries we've done in the general journal, we can see all these transactions, same things we've seen on the previous slides, and I will post this document so you can follow along if you want to and flip back and forth. And then we've posted everything to the general ledger. So here's a summary of the general ledger. We've got all the accounts affected, what the transaction was, and then what the balance was. Okay. So if we do this for Kate Brown, she had the following transactions in the general journal during the month of March. Post these entries to the cash account. Okay, the beginning cash balance of cash on March 1st was $600. Okay, so we have 3 entries here. We're just going to worry about the cash account. We're not going to worry about the other accounts, and we're going to post them into the ledger. If we do it in a T account form, okay, beginning balance $600. Now note it doesn't say what that balance is. Is it a debit or credit balance? Okay, we know it's cash, and what's the normal balance of cash? It's a debit. So unless it says otherwise, we can assume safely that the balance given for any account is the normal balance in that account. So cash is an asset, assets have a normal debit balance, so we can say that that beginning balance is a debit for cash. So in the T account, it goes in the left side debit. On March 4th, we debited cash, so we post that in there. So we show the $2,280 on the left side, the debit side. The 15th and the 19th, we both spent cash for something. We decreased cash. We credited cash in those journal entries. So we record that on the right side, the credit side of cash account. And then to get the balance, we take the 600, add the 2,280. We add up the credits, 492. So we take the total debits minus the total credits, and our balance is 2,388. And finally, learning objective 4, prepared trial balance. Here's an example of Pioneer Advertising. So all those entries we went through, analyzed, journalized, posted. We take the balances from the ledger, and we just show it on a financial statement here. So we have the name of the company, we have the name of the report, trial balance, we have the date, October 31st, and we have the balances in each of the accounts at that time. Okay, this is showing a 2-column trial balance, debits in one column, credits in the other. You can do one column, debits would be represented as a positive, credits as a negative. Doesn't mean that debits are good and credits are bad. It's just how they represented it, and in computer system, that's how they're stored. But the two columns kind of makes it easier. We add up all the debits. We have a total of 28,700. Add up all the credits. We have the same total, 28,700. Okay. So what a trial balance does, it proves that debits equal credits. Okay, that's all it does. Simple as that. So there's limitations for a trial balance. A trial balance may balance even when a transaction is not journalized. So if we paid for some supplies and never recorded that in the general journal, trial balance will still balance. Okay. A correct journal entry is not posted. So if we paid our employees, debited salaries and wages expense, credited cash, but we missed posting that to the ledger, the trial balance will still balance. A journal entry is posted twice. So if we recorded a revenue entry, for example, and we posted it, We forgot to mark that we posted it, and we went back the next day and didn't think we posted it, and we posted it again. Journal can be posted twice in the ledger. The trial balance will still balance. Incorrect accounts are used when journalizing or posting. So if we paid our employees and we were supposed to debit salaries and wages expense, and we instead debited accounts payable, credited cash, our trial balance will still balance. If offsetting errors are made in recording the amount of a transaction, so we should have paid $100 for something, and we recorded it in the journal as 10, and then copied that to the ledger as 10. As long as we have 10 debits and 10 credits and they equal, trial balance is going to balance. Okay, so even though you get to the end and they're equal, it's a good sign that you've done things the right way. You've got debits and credits equal, but it doesn't mean that you've journalized everything, then you posted everything correctly and you don't have an error somewhere. Okay, but it is used and it is helpful to kind of see what the balances are. The note there on the right, an error is the result of an unintentional mistake. So I meant to record 100 and I accidentally typed 10. That's an error. Okay, it's not ethical or unethical. It just happens. You can correct it and move on. An irregularity is an intentional misstatement, which is viewed as unethical. So I have $100 of expenses, but if I only had 10, my net income will look a lot better. So I'm going to purposely only record 10. That's an irregularity. It's intentional, and that is very unethical. Locating errors. Errors in trial balance generally result from mathematical mistakes, incorrect postings, or simply transcribing data incorrectly. So here's some things you can look at and think about if your trial balance doesn't balance. Okay, if the error is $1, $10, $100, or $1,000, just re-add the trial balance, the different columns, and then go back and recompute each account balance. So it could just be a simple adding error. If the error is divisible by 2, scan the trial balance to see whether a balance equal to half the error has been entered in the wrong column. Okay, so if you don't balance, it's divisible by 2, you could have put a debit in the credit column accidentally, and if you look for that amount, the half of the amount that you're off, you might be able to find it easy. If the error is divisible by 9, so you got to retrace the account balance to see whether they are incorrectly copied from the ledger. So a number that's divisible by 9 is most likely a transposition. So 45 versus 54. Okay. If the error is not divisible by 2 or 9, just scan the ledger to see whether an account balance and the amount of the error has been omitted from the trial balance, and scan the journal to see whether a posting of that amount has been omitted. So if you can use one of these quicker ones to kind of isolate the error, it's just simply going back and looking at the trial balance to the ledger and then the ledger back to the journals to make sure you've included everything and posted it correctly. Dollar signs. Dollar signs do not appear in journals or ledgers. They're typically used only in the trial balance and the financial statements. And it's shown only for the first item in a column and for the total of that column. Okay. Underlining, a single line is placed under the column of figures to be added or subtracted, and totals are double underlined. Okay, so let's jump back to the trial balance. If you look at this, cash is the first debit item, so we have a dollar sign in that first item. If we go down the credit side, we have our assets first, so none of those are credits. Notes payable is our first liability, which is a credit balance. That has a dollar sign on it. If we go down to the bottom, there's that single underline under each column, which represents that we're adding that column up. And then we have the totals, the 28,700. another dollar sign on both of those, and then we double underline to prove that that's the total that we've have in the financial statement. So those are just kind of how in accounting we represent the financial statements in different reports. So a review question. A trial balance will not balance if a correct journal entry is posted twice, the purchase of supplies on account is debited to supplies and credited to cash, a $100 cash dividend by the owner is debited to dividends for $1,000 and credited to cash for $100. A $450 payment on account is debited to accounts payable for $45 and credited to cash for $45. Okay, so all four of these are errors. They will make the trial balance incorrect and then your financial statements incorrect, but 3 of the 4 will still make the trial balance, will allow the trial balance to balance. Debits will still equal credits. Since the trial balance proves that debits equal credits, we look for the one where debits don't equal credits, and the answer is C. A $100 cash dividend by the owner is debited to dividends for $1,000 and credited to cash for $100. So we have different amounts in debits and credits. That will cause the trial balance not to balance. So Fannie Mae. So most companies record transactions very carefully. The reality is that mistakes still happen. Bank regulators fined Bank One Corporation, now JP Morgan Chase, $1.8 million because they felt the unreliability of the bank's accounting system caused it to violate regulatory requirements. Also in recent years, Fannie Mae, the government chartered mortgage association, announced a series of large accounting errors. These announcements caused alarm among investors, regulators, and politicians because they feared that the errors may suggest larger, undetected problems. This is important because the home mortgage market depends on Fannie Mae to buy hundreds of billions of dollars of mortgages each year from the banks, thus enabling the banks to issue new mortgages. Finally, before a major overhaul of its accounting system, the financial records of Waste Management were in such disarray that the company's 57,000 employees, 10,000 were receiving pay slips that were in error. So 10,000 out of 57,000 were getting wrong pay checks, pay stubs. The Sarbanes-Oxley Act was created to minimize the occurrence of errors like these by increasing every employee's responsibility for accurate financial reporting. So why does the accuracy matters? In order for these companies to prepare and issue financial statements, their accounting systems, the debits and credits, must have been in balance at year end. How could these errors or mistakes have occurred? The accounting equation can be in balance, yet its financial statements have errors or misstatements because entire transactions were not recorded, transactions were recorded at the wrong amounts, transactions were recorded in the wrong accounts, transactions were recorded in the wrong accounting period. So all of those will still have the accounting equation in balance. Debits will still equal credits, but the financial statements will be wrong. So audits of financial statements uncover some, but obviously not all errors or omissions. Now let's look at how do we prepare a trial balance. So these are accounts from SnowGo Corporation at December 31st, 2027. So we have the account number, the account name, and the balance. Okay, so we need to prepare a trial balance in good form. The first thing we need to do is look at what the normal balance in each of these accounts are. Okay, since it doesn't specifically state, we assume that it's the normal balance of the account. So assets have a normal debit balance, liabilities have a normal credit balance, common stock, retained earnings, revenue all have credit balances, dividends and expenses have debit balances. So again, it goes back to dead. The debits are expenses, assets, and dividends. Everything else is credit. Okay, so now that we have if we've analyzed this and can figure out what it is, we typically put it in order of assets on top and then liabilities and the stockholders' equity. We can do it by sorting this list by the account number. Is an easy way to do it. And here's what the trial balance would look like. So we just list the accounts. We list the balance from the previous slide. We have the debits in the debit column, credits in the credit column, and our debits equal credits. Okay, and that's it for chapter 2. Review this again and look at this document. I'll post this on Blackboard for you. There'll be notes out there that you can look at and practice. Again, accounting is all about practicing and going over this information over and over until you fully understand it and grasp it. As always, if you have any questions or are struggling, please reach out and we can help you.